Hello, and welcome to the 9th episode of Season 8 of the Dark Money Files, in which we shine a light into a murky world. I am Ray Blake, and with me is my co-host, friend and business partner, Graham Barrow. Hello, Graham.
Hello, Ray.
Now, where were we, Graham?
Ray, we had begun our update on NatWest and the story of their relationship with Fowler Oldfield. This was based on the published statement of facts that details the systems and the failures within NatWest at each point in the relationship. NatWest has pled guilty to the criminal charge and has been issued with a fine of £265 million.
Yeah, something of an abusive relationship, really.
Yeah.
We began last time, didn't we, by recapping the background and then moved on to detailing the key events that we now know led to the fine.
Oh, yes, we did. So last episode, we looked at the onboarding, the way the client became an approved customer of NatWest. We looked into the routine oversight of the account during its operation, which is to say the systems, controls and people that were managing the financial crime risk.
So today we'll cover the escalation and investigation processes when alerts were sounded, and then we'll look at how change was handled.
And I know, Ray, that you wanted to come back to three key points. The use of language in the statement, the criminal activity that the Bradford Laundromat sought to bank, and the insights we can gain by looking at the more recent HSBC fine alongside this one.
You're right. We may need a third part, actually, Graham, but we will cover all of that, I promise.
Oh, yes. So let's start with escalations then. What escalations are we talking about?
The statement of fact identifies 11 internal suspicious activity reports, although it calls them something slightly different, and 10 transaction monitoring system alerts.
OK, and just who raised these internal suspicious activity reports, Ray?
Cash centre staff, branch staff, and in one case, Fowler Oldfield's assistant relationship manager at NatWest.
Assistant relationship manager, so not the relationship manager, him or herself?
Himself, actually, Graham, but it seems not.
Oh, OK then. Well, right, so what was the content of those internal SARs then?
It all seems to have been about the cash, Graham. The most sensational part of the statement of fact covers the depositing of cash in a variety of branches and the management of that cash at regional cash centres. It takes up 8 pages of the statement and details what happened at each branch and centre and what their respective suspicions and actions were.
And it is this section, isn't it, Ray, that has been leapt on, shall we say, in the mainstream media reporting of the case?
Well, unsurprisingly, I'd say, Graham, this whole section is pretty staggering. But perhaps you'd give listeners a taste by reading out clause 123 of the statement about what happened at Walsall branch.
Well, I will do that, Ray. I think before I do, you and our listeners need to know that you know this, but our listeners need to know that BQD is the abbreviation for the Business Quick Deposit Service, by which customers could pay in large amounts of cash, potentially without human contact with staff.
That's absolutely right.
Right, well, here we go then. Pause, take a deep breath, and... Between September and October 2015, staff at the Walsall branch contacted the relationship manager suggesting that Fowler Oldfield should arrange cash collections given its excessive use of BQD bags, which the branch could not sustain. For example, on the 14th of September 2015, the branch reported that Fowler Oldfield had deposited £700,000 in BQD deposits in a single day. The volume was unprecedented, according to some of the staff. At times, thousands of pounds in cash was brought into the branch uncounted in big black bin liners. A member of staff later told FCA investigators that they often found that the weight of the cash was too great for the bin liners, which would then break. staff would have to move the cash into stronger Hessian sacks to prevent the cash falling out. The cash filled the branch's 2 floor-to-ceiling safes. Excess cash and other items had to be stored behind grills in the vault. This was less secure and in breach of the bank's policy on cash controls.
And the statement goes on to note that the issue caused difficulties for the Walsall branch staff and concerns about the security of the physical bags of cash. The relationship management team said this would be a short-lived problem. Staff at the branch intended to raise an internal SAR, but the bank can't find any trace of one.
Oops. And cash deposits were still ongoing at Walsall in 2016, with the final deposit occurring in May 2016. A total of £6.6 million was deposited at that one branch. Not quite the short-term issue it was sold as, Ray.
Indeed not, particularly if we look beyond that branch. And that's just representative of what's described in the statement as having been happening at a whole range of branches.
And in cash centres too.
Yep, even those special functions specifically designed to handle bulk cash are having trouble with the Fowler Oldfield volumes.
But, riveting though this all is, Ray, I can't help thinking that isn't the real story, at least not the significant bit of it.
Oh?
Well, no, the real jaw-dropper here for me is the really varied responses of the branches and cash centres. Some, apparently, didn't bat an eyelid, while others were making a noise and formally escalating concerns.
Yeah, now that's a real issue. And it wasn't for a shortage of guidance and policy either, Graham. The statement includes an assertion that, quote, NatWest's AML systems and policies were broadly in line with relevant industry guidance, unquote, for instance. And elsewhere details guidance from 2014 that provided employees with examples of money laundering red flags.
Yes, I saw that, Ray. The statement lists some of the flags it included, doesn't it?
Yeah, it does. The first is large quantities of £100 or £50 notes paid in by a customer when their pay-ins usually consist of 20s and 10s only.
£100 notes, Ray? They don't make them.
Well, they do in Scotland, Graham.
Ah.
Yeah, which brings us to the second example. Large quantities of Scottish or English notes being paid into the incorrect part of the country.
Yes, because there were the quantities of Scottish notes being paid in at 50 branches, all in England, none of them actually in Scotland.
Yeah, that would have been really obvious. As the report notes, the machines at the cash centres were only set to automatically count Bank of England notes, so there was an ongoing manual overhead to count the Scottish ones.
And this was recognised. The statement details how Washington Cash Centre instituted their own inquiries around this.
Indeed. In the summer of 2014, the bank was approached by the NCA, who were undertaking a strategic assessment of the repatriation of Scottish banknotes to Scotland from the rest of the UK. Law enforcement officers held the belief that the seizure or discovery of large amounts of Scottish banknotes in England was an indicator of criminal activity, particularly in connection with the illicit drugs market.
And when you consider that another frequent observation of staff was that there was a musty smell coming from this cash, that ought to have raised the alarm.
Well, it did, Graham. That 2014 work with the NCA involved the bank on a no-names confidential basis, using Fowler Oldfield, although it wasn't named, as a case study, an example to illustrate to the NCA the prevalence of Scottish notes in England. Well, the NCA didn't like the sound of it and issued a formal request for information about this unnamed customer, stating, "It is our assessment that this money may have been related to the trade in controlled drugs."
But this request for information was under a provision of the law that made it voluntary for the bank to provide information, and ultimately it chose not to, didn't it?
Yeah, despite at least one financial intelligence unit manager's serious misgivings, and we'll come back to that.
So, back to the red flags guidance. What else was included?
OK, next one. Unusually large deposits made by a company whose business activities would normally be generated by cheques.
Which is ironic, given that this is exactly what the transaction monitoring system thought was happening. It was misclassifying all that cash as cheques.
Well, yes, indeed. The guidance also includes large cash deposits using facilities which avoid direct contact with bank staff.
Well, that is pretty much an exact description of the BQD service that was in use by Fowler Oldfield.
It absolutely is. Finally, another example red flag that's listed is substantial increases in cash deposits of any individual or business without apparent cause. Now that brings us to the way the bank dealt with change, which we'll come on to.
Yes, but in short, there was policy and guidance that really should have led to the right outcomes here at quite an early stage. We've got transaction monitoring alerts, although perhaps not as many as we might like, as we discussed in our last podcast episode. And we've got internal SARS being escalated. This is all painting a picture. And yet I think I'm right in saying that the bank isn't filing any SARS with the law enforcement agencies.
That's right, Graham.
None at all?
No. Not until 2016, when NatWest was notified of the NCA and West Yorkshire Police's investigations into Fowler Oldfield. And then they retrospectively filed a whole slew of them.
OK, well, we can come to those in a moment. But why weren't there any SARS issued before then?
Well, putting together a number of observations throughout the statement, it appears clear to me that at pretty much every escalation, the relationship manager was pouring oil on any troubled waters.
How do you mean, Ray?
Well, as the key point of contact with the customer, most escalation processes involved consultation with the RM to provide any context and explanation for activities that were unexplained.
Even at the point of investigating internal SARS, Ray?
Well, yes, Graham, because there was no other way that the investigators could access key details of the relationship.
I think you need to say that again, Ray.
The report makes clear that at the time, the investigators could not see the systems used by relationship management teams to record customer information and discussions.
That looks like a bit of a blind spot.
Yeah, it's one that was subsequently closed, but at the time they were reliant on the relationship manager to fill them in, and he seemed pretty keen at every point to reassure them that all was well.
Can you give some examples, Ray?
Well, he said that Fowler Oldfield had engaged a prominent local solicitor to conduct AML due diligence independently on Fowler Oldfield's own clients.
And was that true?
No, Graham. He said that HM Customs and Excise had visited Fowler Oldfield many times, each time giving them a clean bill of health.
And was that true?
No, Graham. And for me, most significantly, he said at every point that the cash deposit activity of Fowler Oldfield was not only in line with the type of business and his expectations, but that it was in line with what was envisaged at the outset of the relationship.
And we've already established that that was not at all true.
When asked specifically about all the Scottish currency that was being banked in England, he said this resulted from two of Fowler Oldfield's biggest clients having operations in Glasgow.
And was there any verification of that, Ray?
Well, none that I've been able to identify as such, no. The bank wasn't blind to this reliance on the relationship manager. In September 2014, a financial intelligence unit manager stated that she was, quote, uncomfortable that the non-disclosure of this client appears to have been mainly decided based on the RM feedback, quote. This FIU manager queried the customer's trading activity, the high volumes of cash, the use of expensive deposit channels, the customer's relationship with a purported food wholesaler, the explanations provided by the relationship manager which filled her with what she called grave concern, and the rapid increase in turnover during 2014.
And yet still no SAR was submitted. Her concerns weren't shared with investigators who decided not to make a disclosure to the authorities following explanations received from the relationship manager that he was comfortable with the relationship.
So I suppose the obvious question is, was the RM in on it?
You mean, was he in league with Fowler Oldfield, or was he just in too cosy a relationship with them and not dealing properly with a conflict of interest, or was he merely incompetent?
Well, it has to be one of those, right?
Well, all I can say, Ray, is that according to the statement of facts, he was arrested. He's not been charged, but remains under investigation by West Yorkshire Police. The bank dismissed him for misconduct, including gross misconduct, in 2018. I think we'd probably better leave it there.
I agree. But actually, Graham, it's not technically correct to say there were no external SARs involving Fowler Oldfield prior to 2016.
Really?
Let me take you back to August 2015, Graham, when Fowler Oldfield was listed as an associated party, a remitter, in one SAR submitted to the NCA.
Tell me more.
Well, an alert had been triggered on an account belonging to a supplier of hair extensions, wigs, hair accessories and cosmetics.
It's going to sound a stupid question, Ray, but why?
Well, according to the SAR, the company had received approximately £387,000 from Fowler Oldfield.
A supplier of wigs?
Yes, Graham. Following that payment, funds were then transferred to a pub business.
Well, of course they were.
Before being transferred out to money transfer businesses.
And presumably this rang alarm bells in respect of the Fowler Oldfield relationship.
Well, according to the statement of fact, this did not trigger any independent review of the Fowler Oldfield relationship by the bank.
As we know from the last episode, there were only 2 event-driven reviews on the Fowler Oldfield account, and apparently this was not one of them.
Indeed, Graham.
So, when NatWest did start filing SARs, albeit belatedly, what did they cover?
Well, there were 13 of them, Graham, and they included references to a dramatic increase in cash deposits from December 2013, the high proportion of Scottish notes and the prominent smell to notes. The nominated officer gave us the reason for one SAR in August 2016. The activity seen on the accounts of the business is not in line with expectations for the nature of business. We have been unable to identify a legitimate rationale for cash to account for the vast majority of turnover for a wholesale precious metal dealer. Furthermore, cash credits being made up of a high proportion of Scottish notes is inconsistent with what is ostensibly a Bradford-based business.
For some reason I'm seeing a stable door being closed and a horse galloping off into the horizon here, right? But that would seem to summarise things very nicely, and I'm with the NCA here. This shows all the signs of laundering the cash proceeds from illicit cash drug sales.
Through a company with a century of ostensibly legitimate commercial activity behind it.
Yes.
Now, Graham, that brings us straight to the fourth aspect of NatWest's conduct here, and that relates to how they responded to change.
Well, I think we've already got a flavour of this as we've been going along, Ray. There's the sudden appearance of cash, the significant acceleration of cash deposits, the changes in risk rating and business model. Any other examples?
Well, there's a quite intriguing one early in the relationship, Graham. Right back in 2011, a new director is appointed to Fowler Oldfield, who goes on to invest £200,000 into the business, £100,000 of which purportedly came from his mother. There's no event-driven review here, no source of funds inquiries in relation to the mother, and it happens again when a new director is appointed some months later. The bank's policies say each of these required an event-driven review, but it didn't happen.
Yeah, I notice the statement keeps coming back to missed event-driven reviews, doesn't it?
Yeah, it specifically calls out 3 other occasions where EDRs really should have been conducted and might have made a real difference.
OK, so what were those?
Well, first, when cash deposits began to be received in ever-increasing amounts. Second, when the NCA formally requested information on Fowler Oldfield, although it didn't know it was Fowler Oldfield, in July 2014, around the Scottish banknotes issue. And third, when the SAR was submitted in 2015 to the NCA on the hair accessories business, listing Fowler Oldfield as a remitter.
And I have to say, Ray, that how a firm recognises and responds to change is at the core of how effective it is in its anti-money laundering policies and procedures and implementations.
So why is that, Graham?
Well, Ray, because change is an indicator of money laundering.
Well, how so?
Well, if you think about it, in order to be your client, any company has to have got through onboarding. You have established through due diligence all the relevant data. You know who owns and controls the business, where the money comes from, what the business does. You've satisfied yourself that the envisaged usage of your products and services is consistent with the nature of that client's legitimate business activity.
Agreed.
And provided that none of that changes and that actual usage is broadly in line with envisaged usage, all is good.
Yes, it is.
But let's assume that company's about to start laundering money. One of two scenarios exists. First, it lied to you when you onboarded it. It told you what you needed to hear to open the account. For a while, maybe it showed you what you expected to see in the account activity.
But that has to change, doesn't it?
If it wants to launder money, Ray, yeah. And you have to be alert and responsive to that change.
It might be explicable and legitimate, but you'd check and confirm that was the case.
Indeed you would.
You said two scenarios, Graham. What's the other?
Well, a good company could suddenly go bad. You might have had a good relationship with them for a short while or a long while. They might well have been a legitimate concern, possibly for decades, but suddenly they go bad and they start laundering money.
How does that happen, Graham?
They might have had a change of ownership or control, Ray. Perhaps a new director.
Or two, perhaps?
Or, as you say, two. Perhaps a new joint venture with someone.
But in any case, there's an identifiable change.
Yes, always. Something changes and it gives you the opportunity to look closely at that change and decide whether you're comfortable with it or not.
And in the Fowler Oldfield case, we have a virtual textbook case of multiple changes, each of which should have been more clearly recognised and or acted on.
And I think that's an entirely fair comment.
Graham, we've spent countless hours reading the detail on this case, and there's one particular outcome from that I wanted us to talk briefly about.
Is this the language point, Ray?
Yes, it is, and we've already seen some examples of strikingly different language across the statement. I think it leads to an important inference.
Why don't you explain?
OK then, let me take you back just as an example to the coverage of client reviews. You'll remember that the client was accepted with the proviso that the relationship manager should conduct a review after 6 months.
Yep, I do remember that.
Well, the statement notes, quote, "There is no documentary evidence that establishes whether or not the relationship manager conducted the desktop review."
And that's fair enough. It doesn't rule out it having happened, but there's no evidence that it did. This is a key legal document, and this wording will not be accidental. It's a form of wording that both the prosecution and NatWest are happy with.
Contrast that with the following sentence, though. Quote, "Fowler Oldfield was not subject to any periodic reviews during the lifetime of the customer relationship."
Yeah, I see what you mean, Ray. That is really definitive, isn't it? Why isn't there the careful hedging that there was on the matter of the special 6-month review? Why doesn't NatWest get the benefit of the doubt, or at least the acknowledgement that there is a doubt?
Well, when we look at the one-off review, there's nothing to compare the bank's performance with. This was a one-off, not a routine operation. It would be hard to state definitively and reliably that it didn't happen.
And that is fair.
But periodic reviews are another matter. They apply to every client. They are a routine requirement. There's lots to compare the performance in this individual case with.
And if you look more generally at the bank's performance of this control, you ought to be able to conclude whether an absence of evidence can be read as evidence of absence. Is it credible when looking at the bank's general approach that this was done, just not recorded, or recorded but the record not retained?
And the inference is that no. It's not a reasonable conclusion. It seems to me that you can't make such a bold and unambiguous statement without insight on the bank's actions that go beyond just this case.
So, either the bank were generally very good at undertaking and retaining documentation of their reviews, so the fact that there's no record in this case means that we can be fairly sure it didn't happen.
Or, conversely, the bank were generally bad at undertaking reviews, and consequently we're pretty sure it never happened in this case as in many others.
It has to be one of those two, doesn't it? But of course, this is a statement of facts in this case only, and you wouldn't expect any comment on wider failings.
Well, that's true, Graham, but let me point you to clause 11 of the statement, quite early on, which states, some of those deficiencies would have affected business relationships with customers other than Fowler Oldfield.
And it's also reasonable to wonder whether the problems we saw last week with the transaction monitoring system for this case, seeing cash as checks and rules being switched off, for instance, might also have caused issues beyond Fowler Oldfield.
It's an open question, Graham, for now. But we've banged on for ages again, and I think we're going to have to overflow into a third part on this.
Yeah, because we haven't yet brought in the HSBC action, and nor have we properly distilled the learning that other firms should draw from the two cases. So let's do that next time.
I'm looking forward to it.